Dear valued investors, financial markets have experienced quite a bit of change this year in just 2 short months. We started the year hopeful that stocks would benefit from a better economic and monetary policy environment by the spring. But recent developments suggest that may be further out than we initially thought. We remain confident that a new bull market will come. But again, I remind you that it may require patience before we get there. At the start of the year, we had hoped for a spring timeframe for the start of a shift in Fed policy from a tightening campaign to a pause and watch the data stance. Following recent data pointing to stronger growth and higher inflation, rate hikes may extend into the summer and potentially delay the start of a new bull market. Against that backdrop, even though stocks pulled back in February, this year's flat market for the S&P 500 index feels like a victory to some small extent. Recent evidence of consumer resilience has been encouraging. Over 500,000 jobs were created in January, according to the U.S. Bureau of Labor Statistics. This is nearly triple the economists' expectations, and the February report is much anticipated by the market and will be released on March 10th. The unemployment rate is at its lowest level since the 1960s. Retail sales rose better than expected 3% in January month over month, as consumers benefited from a healthy job market, excess savings, while also motivated by the diminished COVID-19 threat, and with perhaps a small assist from mild winter weather. However, that consumer strength was accompanied by a series of hotter than expected inflation reports for January, fueling more concerns about higher interest rates and, in turn, weighing on the stock market. Rewards for investors will come. They always do. But they will require more patience. In an environment where inflation has been frustratingly slow to come down, with the Fed still very much intent on combating it, our patience is being tested. The risk that the Fed tightens too much and drives the U.S. economy into a recession has risen. Higher interest rates also puts stress on stock market valuations. So the longer we worry about the Fed, the less likely we are to see the bull market arrive in the short term. Corporate America is not in a position to help much, given earnings declines are likely during the next 2 or potentially 3 quarters. Still, we remain steadfast in our belief that investors' patience will be rewarded. Warren Buffett wrote in his latest annual letter to shareholders, "There has yet to see a time when it made sense to make a long-term bet against America." Stocks have generated annualized returns of over 9% since the advent of the S&P 500's predecessor index, the S&P 90, back in 1927. And that includes the Great Depression, World War II, the dot-com crash, the 2008-2009 financial crisis, 9/11, and numerous other economic and geopolitical shocks. Stocks may be volatile until the direction and ultimate destination of interest rates becomes clearer, but new highs will come eventually. In closing, we expect investors who put money to work in Q1 and Q2 to be rewarded with solid gains this year. The next bull market may not arrive in time for spring, but stocks may still ramp up this summer as inflation eases and the Fed finally hits pause on rate hikes. Please contact me if you have any questions. Stay safe and stay the course.